Welcome to the program, ladies and gentlemen. We've got another action-packed show answering the questions about the effect that the coronavirus is going to have, or maybe it won't have. Stay tuned for that. We'll also talk, of course, it's tax time, so we'll talk a little bit about deductions versus credits. What's the difference and which one is more important? We'll answer that on the program. Plus, we'll also talk about the latest analysis that was done comparing whether you should invest your money or pay off your mortgage. The numbers in the analysis may actually surprise you at who won and who lost in that analysis. This program, of course, is aptly titled Dollars and Cents, where we help you make sense out of all of those different decisions that have anything and everything to do with your dollars. My name is Joel Garris of Nelson Financial Planning, and you are also listening to a program that was recently named one of the top 25 financial planning podcasts on the World Wide Web. So pretty cool. So if for some reason you're missing the live show, you can always catch us on our various formats, whether it's YouTube or Facebook or iTunes or Google Play or and the list goes on and on. To find out which channel you'd like to listen to us on, you just need to go to our website. That's nelsonfinancialplanning.com. And in the upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar to you, and you'll get immediately connected to our program channels on those various social media outlets. If you subscribe, then every time we put a show up, then you'll know. So also a good way to stay in touch. Before we get to all of that, though, we are back live in the studio. Last week was kind of one of those rare episodes where we taped the show. We taped the show for a couple of different reasons. First of all, we were delighted to have Dr. Sean Snaith in the studio with us last week. A pretty interesting conversation covering a range of topics from the national debt to the economy to the situation right here in Florida in terms of economic improvements and unemployment numbers. Sean is the director of the Institute of Economic Forecasting out at UCF. We were fortunate enough to have him speak to our clients at one of our typical client events that we host every quarter, where we bring in speakers from various parts of the industry and ultimately give our clients the opportunity to learn a little bit more about what's going on. Well, needless to say, we certainly learned a lot from Sean in the presentation to our clients and then the recap that we taped for last week's program. Also, the other reason why last week's program was actually on tape was because I was out there running a marathon over in Melbourne. Survived. That's why I'm still sitting here. A little sore the first couple of days, not too bad. Managed to finish this one actually 28 minutes faster than the first one I ran, which was a year ago. So feeling good about that. And plan to run another one. We enjoy it. So it gives us something to work towards in terms of our physical fitness goals. And so we will continue to do that. Also on the program a couple of weeks ago, we talked about a scam that was delivered to you courtesy of UPS. Now, it's not a scam from UPS, obviously. It is somebody that was putting fake checks in overnight envelopes from UPS and sending it to you with the notion that you would cash it and then bad things would happen after that. Folks, this time of year, it is like Christmas season for criminals because everybody's thinking about their finances. Everybody's sort of on alert given that it's tax season. And there's a lot of questions that people ask when it comes to their finances in terms of bringing together documents and things like that. And the professional criminals that are out there that are looking to take your hard-earned dollars away, they know that. And they know that you are most susceptible during this time of year. So the reality is, though, we keep talking about this on the program because it keeps being a problem. just this past week, we had two distinct situations that we want to alert our listeners to, so to make sure that they do not fall prey, much like these people did. First one involved somewhat of an elaborate scheme involving having to pay a bill that ultimately directed this individual to go to the store and buy prepaid cards in order to then turn around and give the numbers to the person on the line. Now, when you hear it for the first time, you're like, man, there's no way. How could somebody fall for that? But these people, again, are professionals. They're very good at what they do. And so if anybody asks you to go to the store and buy something and then come back and call them and give them the information, don't do that. Okay? That's a scam. They're going to rip you off. They're going to take that information. They're going to use it. You're going to be out your money. So if somebody asks you, somebody's calling you and somebody asks you to go to the store and get me a prepaid Visa card and then come back home and give me the numbers of that card, don't do that. Don't do that. That one is one version. The other one, which is a newer version that we've kind of been hearing a little bit about, is, again, something that kind of catches you off guard. And this one involved getting a phone call from someone who said that they were with the power company or the cable company or the utility company or whatever the case may be, and saying that you did not sign the check. The check that you just sent us for the bill, you did not sign it, and so you need to pay right now, instantaneously, just a little bit, just a nominal fee, so that we don't come out and disconnect your power or your phone or your internet within the next hour. And you think, okay, well, it's only $5. Sure. Okay, so you wind up giving them that credit card information or perhaps even the bank account information, and then all of a sudden it's a problem. Because then what happens is they rack up, they use that credit card information, and they then charge things fraudulently on it. Had that one happen just this past week as well, in terms of going through and getting tripped up on that scam. So we tell you that stuff, particularly this time of year when it happens more frequently, although these days it's like Christmas year-round for professional scammers and thieves like that. But just know those two. If someone sends you off to go get a prepaid card, it's not real. Don't do it. If someone calls you and says, we're going to cut your power and you need to pay us something immediately, let's go over what your best strategy on that should be. Number one, if they tell you a number to call back, don't take that number. That number is garbage. That number is nonsense. What you need to do, and folks, look, the power company is not going to give you a 1 hour notice before they come out and shut your power off. It does not work that way. There is a process of time that they have to observe before they'll run out and just cut it off. So take a moment and find your account statement on that particular account that you just got the call for. Okay, so you get a call from the power company, you get a call from the cable company. Find your statement for the power company. Find your last statement for the cable company. And then call that number on that statement. Don't call any other number. Call that number on that statement and talk to them directly. The reality is, if you call the number that the people that called you gave you, it's not going to be a valid number. So be mindful of that. Be careful of that. You've got to be on your toes. These guys are very good. You let your guard down just a little bit, and before you know it, you're going to be giving them a prepaid credit card number, or you're going to be giving your credit card number, you're going to be giving your bank account. you want me writing them a check. Just understand that unfortunately, in today's world, if anything like that happens, you have to stop, you have to do your own research, and you have to address it through statements that you have on your end by calling those numbers rather than chasing around and getting scammed by these professional criminals. So be careful of that. And I don't like to necessarily repeat topics that we've talked about on the radio program too often, but this one, again, it just keeps becoming a bigger and bigger problem, particularly for our seniors that become the targets of that. Look, these people that are doing it, they know who you are, they know your relative age, and that's what they're going after. So be careful. And by the way, it's not just seniors that get tricked. It's all age groups. So pay attention and make sure that when you get a call that you politely ignore the call, but then follow up directly by pulling up your own account statements and making the call using the number that's on the account statement that you've got in your hand rather than relying on the information that they are giving you. So, consumers beware. It's out there. It happens more regularly. Good people get caught on this every single day. It's not a question of judgment. These people are very good at what they do, and it's easy to get tricked. That is for sure. So be careful of that out there. We're going to take a break. When we get back, we will talk about the thing that is driving a lot of headlines right now, and that is the coronavirus. We'll talk about that, its potential economic impact as well, and what you should be doing now as it relates to your investment portfolio in light of that outbreak. So all that and more when we get back. Stay tuned. This is Dollars and Cents. Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando. Howdy, friends. Dollars and Cents here. This is Joel Garris of Nelson Financial Planning. We're talking a little bit about the coronavirus that's making headlines across the planet. Obviously, this is the outbreak that started in Wuhan, China. Starts with sort of some flu symptoms, fever, cough, shortness of breath, and then goes from there. The numbers very quickly are getting quite large. It's estimated that there are over 30,000 cases and 600 dead of this outbreak that started not all of that long ago. You see the pictures on TV, the mass quarantine camps in China, a real health crisis. The reaction has been shutting down cities or quarantining cities, and a number of businesses have also shut down. So you have to ask yourself, okay, so what's the economic impact and sort of how does this play out? Because certainly you see companies like McDonald's, companies like Starbucks, who have major operations over there, KFC, another one, that ultimately are having to close their stores. Starbucks alone closed about half of its 4,300 stores in China. Obviously, that affects the bottom line. Plus, layer on that, you have the backdrop of the trade war that arguably just sort of got somewhat resolved, but it was definitely having a greater impact over in China, and the Chinese economy was projected to slow at its slowest rate in 30 years. Now, okay, of course, China's had a pretty high economic growth rate. And a slowing economy in China means that it's only going to perhaps wind up growing at 5%, which is still pretty good growth rate when you stop and think about it. And so that decline in economic output, particularly in the first quarter, obviously that's got some significant economic implications that could certainly ripple the rest of the global economy. When you look at not just companies that have shut their operations in China, but also the disruptions that it can have to the supply chain for a company like Apple. Now, the Chinese government, obviously cognizant of these issues, is very much in a stimulating the economy by producing a lot of yuan, which is their currency, and sort of injecting that into the economic system, much like we've seen our Federal Reserve do that with quantitative easing, with lowering interest rates. So too does the Central Bank of China sort of have those same tools. And it's estimated that they have injected somewhere around like $200 billion into the economic system in China to help offset the economic impact of what this virus has produced. Around Asia, you've seen the Asian markets, China, Hong Kong, and Thailand, sort of get a reaction, particularly in their stock market. Why Thailand? Well, Thailand is a very heavily tourist-dependent country based upon tourists coming in from China. And so we've seen those markets in particular down relatively steep, 6-7% in terms of the sell-off in those stock markets. Here in the U.S., we had one sort of bad reactionary day a week ago Friday, but then this past week, markets generally rebounded and recovered from that. There was also a relief of China from its tariffs on another 75 billion of goods, meaning that they pulled back on the tariffs for another 75 billion of goods. And so consequently, you see the Chinese government sort of operating in such a way as to help balance out the economic impact. So the reality is, how does this sort of all play out, right? And anytime we're asked that question, we always kind of take a step back and say, well, have we seen this before? What does it look like? And how does it generally play out? And what's interesting, when you stop and think about it, over the course of the past 20 years, there's been 5 or 6 of these funky virus outbreak things that have occurred, right? So back in 2003, it was SARS, right? And then it became the avian flu. And then there was the swine flu. And then there was MERS in 2013. And then Ebola. And then Zika as recently as 2016. Now, the Zika one I particularly remember because that year my family and I traveled to Costa Rica. We came back, and my youngest son actually developed like flu-like symptoms, fever, headache, all that, as you might well imagine. There was some testing that was done to make sure that it wasn't Zika. Fortunately, it wasn't, but you get the idea. It does have a tendency to create a lot of attention and a lot of panic. It's the reality is that a little perspective always goes a long way. So we'll start with some perspective in terms of flu season here in the U.S. We're in the midst of flu season, and according to the CDC, at the beginning of the month, there had been 10,000 deaths during the course of flu season from the flu this year. And a total of 180,000 people had been hospitalized. Not trying to make light of the numbers for the coronavirus, but 30,000 cases, and arguably there's probably a whole lot more that the Chinese government is not telling us about. 600 dead, again, probably a whole lot more that the Chinese government is telling. But a little perspective goes a long ways. During our normal flu season here in America, country of 350 million, 10,000 people die and 180,000 get hospitalized. Those are the numbers for the current flu season as we stand at the beginning of this month. So little perspective always goes a long ways, particularly when you start to look at the numbers of what normally happens during the course of our time here as Americans during going through the normal flu season. So a side takeaway on that is you better get your flu shot. I got my flu shot. Hopefully you got yours. You don't have to look very far to find a place to get your flu shot. So make sure you get your flu shot so that you're not part of these statistics. But a little comparison always goes a long ways. And the reality is that these headline events, like most other headline events, create a reaction. In this particular case, there could certainly be some broader economic implications to the Chinese economy, to the Asian economy. And so consequently here in this first quarter, you may very well see and you're already seeing it, a dip in the economy for that part of the world. But here's the reality. Much like all of these other diseases before us, MERS, SARS, Ebola, Zika, eventually there is some sort of a solution that is found and it passes. And so what you typically see after these is almost like sort of your traditional V-shaped recovery, whereby going through the process, there's a reaction, there's a pullback in the market, there's a pullback in the economy, and then consequently, once it passes, then you see sort of a catch up or a makeup on that. And so that would be the sort of thing that we would expect here, where you're seeing a reaction. The reaction is going to have an economic impact in the short term, and then subsequently there's sort of a catch up of, okay, now we got to catch up on what we were not able to do during the period of time where this outbreak was at its peak. And I think the coronavirus will certainly play out very similar to the pattern that we've seen play out in these various other diseases that have occurred over the course of just the past 20 years. And of course, a little perspective goes a long ways, right? 30,000 cases and 600 dead of the coronavirus. Flu season here in America has already claimed 10,000 people and hospitalized 180,000. So a little perspective always goes a long ways, doesn't it, folks? And certainly a health crisis for sure over in China. We're not trying to make light of that, but a little perspective and a little bit of perspective in terms of the economic impact, certainly an immediate economic impact, particularly when you have cities and businesses closed and quarantined. But generally that period of time is followed by a period of time where those businesses, where those consumers catch up on doing the things that they would have done, but they weren't able to do. And then consequently, you have a catch up, really economically speaking. So the classic sort of V-shaped economic decline and then economic recovery occurs. So we would expect that to happen. Obviously, stay tuned as we go forward as this story develops. But we would suspect it's going to play out very similar to other types of things that have happened, very, very similar to it. Obviously, we'll have more to say on that as the situation develops, but that's our view for now. And so consequently, we'll take a break. When we get back from the break, we will continue the conversation here on the program. We're going to talk about whether you should pay off your mortgage or invest the money. All that and more when we return here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You're listening to a program that was recently named one of the top 25 financial planning podcasts on the World Wide Web. A couple of shows from Australia, one from Ireland actually made the list, and so too did little old Dollars and Cents here in Central Florida. So very excited about that. Go to our website to learn more about that. Accolade. Plus, if you'd like to subscribe to any one of our social media channels, you can do that by going to nelsonfinancialplanning.com. Upper right-hand corner, a bunch of icons. Click on one that looks most familiar to you, and instantaneously you become a subscriber, whether it's YouTube, Google, iTunes, whatever the case may be. We're there, and you can be as well. So on this part of the program, we thought we would talk a little bit about, should you pay off your mortgage or should you invest that money? Very traditional financial argument that you hear a lot about. An interesting new study and analysis was done on it. That study was actually something that was shared with us by a longtime client. And so it's the kind of thing that we like to talk about on the program, because there's a variety of ways in which to look at this puzzle. And certainly the analysis that was done had some interesting conclusions. So what the analysis did is it looked at sort of rolling 40-year, 43-year periods of time back to like 1971. And it looked at the S&P 500, the rolling return of the S&P 500 over a 5-year period of time. It also looked at the rolling performance of the S&P 500, which is a performance measure of the 500 largest companies in America, generally thought of as sort of the bellwether, if you will, for the overall market, hence because it has 500 different companies in there. So it looked at 5-year rolling numbers, meaning the performance over a 5-year period of time, and then 10-year rolling numbers, and then compared that to the average mortgage rate set forth by Freddie Mac during that same period of time. And what was fascinating on it is that it really comes down to, as do most things when you're trying to pick between different ways to invest, there's an economic term called opportunity cost that summarizes exactly what the difference is. If I invest money this way, then I'm not able to invest it this other way. And so what's the difference? That difference is typically described as your opportunity cost. And so that opportunity cost really comes down to your investment horizon and your tax situation. Interestingly, when it looked at the performance of the S&P 500 and adjusted that for taxes, because obviously you have to pay taxes on dividends, capital gains, things like that, and then also adjusted the results of paying the mortgage for the tax savings. What was interesting about that is that paying off the mortgage or investing the money wins about 53% of the time. Well, 53% of the time. And some of the other numbers that they ran, it was like 60% of the time this one wins, 60% of the time that one wins. What was interesting about the entire analysis is just how close it really was. There was certainly no definite winner, do this versus do that, depending upon the period of time. It was very close in terms of which one ultimately came out. More often than not, paying off the mortgage and investing the money was very close. If you take out the tax benefits, then maybe you get a little bit ahead by investing the money about 60% of the time. The reality is, though, that there are certainly some other things to consider, particularly in retirement. So it really boils down to, if you've got money, to be able to invest it or to pay down the mortgage, I think you really need to be thinking about it in terms of where it will really matter, and that is that cash flow issue will become paramount when you get to retirement. Because obviously, if you still have a mortgage, then you've got a major burn of cash flow during the course of retirement. So one of the things that we always say to people is, make sure that your mortgage is paid off when you get to retirement, because you're going to need that additional cash flow for one of two things. One, which is something that nobody really likes, but it exists, particularly when you're retired, and that is paying for your health care. Big cost. More often than not, if you're working, your employer pays for it or pays for a large chunk of it. When you retire, then now you've got to pay for it all on your own. And then number two, something that we like to refer to as free time expense, right? If you're retired, you got free time. If you have free time, generally you're not just sitting on the couch. You're out there doing things, and guess what? You're out there doing things, and that costs money. Versus when you were working, you just went to work, and you weren't taking time off to golf or to hop in the RV or to travel or whatever the case may be. All of those activities take money, and that is a new expense that you have in retirement. So typically our suggestion is to make sure that you have that mortgage paid off, or you certainly have it as part of the cash flow. It really boils down to, if I've got cash, what's the best thing to do with it? And if you have your mortgage structured so that it is fully paid off in retirement, then that obviously is the best case scenario. Now, some things to consider in that analysis. First of all, if you've got higher interest rate debt that's outstanding, obviously the dollars need to go to that before they can go to the mortgage. There's also something to consider there in terms of your risk profile. Paying down a mortgage obviously gives you a guaranteed return. that ultimately you're avoiding the cost, maybe 3, 4, 5%, depending upon what your mortgage interest rate is. You're ultimately avoiding that cost, that drag on your cash flow. And so consequently, you sort of get almost like that rate of return by ultimately eliminating the mortgage. So be mindful of the cash flow. Make sure that you are fully connected to the amount of money that you need to put on your mortgage to make sure that it is fully paid off. But certainly an interesting analysis. At the end of the day, no real clear, decisive victory for either pattern, paying off your mortgage versus investing the money. So certainly it's a toss-up. I think the best way to approach that toss-up is you certainly want to be investing money on a regular basis, but you also want to make sure that over time, the payments that you're making on your mortgage will effectively eliminate that mortgage by the time you get to retirement. I think that's the proper balance to strike. I'm not a particularly big fan of if I get a large chunk of money, maybe I inherited, maybe whatever the case may be, I get a bonus, whatever the case may be. I'm not a particularly big fan of taking all of that and immediately trying to pay down on the mortgage with that. I would rather see a mortgage paid off over time using cash flow rather than the first time you get a chunk of money, it sort of disappears into the mortgage. So the one caveat to that would be chunks of money, I think, are better served getting invested because that gives them a longer time frame in which to invest. It also, let's face it, an investment is always going to be more liquid than a house, right? I mean, you can take money out of the investment to go on a trip. Can't really take money out of the house to go on a trip. I suppose you could if you were doing a home equity line, but why would you do that in retirement? Because now you've got a debt that the whole point of is to not have a debt in retirement. So remember the liquidity aspect of it as well. So I think in the case of where I get a chunk of money, I would rather see that invested, particularly since this analysis grants it a little bit of a toss-up. And then the goal is pay the mortgage off over time. It's very easy. There's a bunch of amortization calculators, things like that out there on the web that you can plug in the numbers and figure out, okay, if I just add $250 or $350 more per month to my mortgage payment, it's paid off in X years, and make sure that X years is when you plan to retire. One other comment on the tax side of things, the tax benefit of a mortgage, which again is why this analysis winds up being much closer. The tax benefit of a mortgage interest deduction is not as valuable as it used to be. In today's world, with the higher standard deduction, approximately 82% of homeowners that have a mortgage will wind up not being able to write off that mortgage interest because the new standard deduction is so high. For those that do, though, it makes a lot of sense to have that mortgage interest because for the vast majority of homeowners that are writing off mortgage interest, what the analysis is that those people find themselves in the 24% income tax bracket or higher. So the higher your income, the more the justification is to have that mortgage interest and to have that mortgage interest deduction. So some interesting ways to kind of look at it. Interestingly, the study concluded that there wasn't really a clear, significant winner to the process. It was sort of a toss-up, if you will. And so in our minds, that means, well, then if it's a toss-up, then you probably should be doing both things and do both things along the way as you approach retirement. But bottom line is to not have that cash flow item in retirement. So make sure that you time the payoff with when you plan to retire. So some interesting numbers on that we wanted to share. We're going to take a break. When we get back, we will continue the conversation. It's tax time, so we'll talk a little bit about the difference between credits versus deductions, which one is more important for you. Plus, we'll also fill you in a little bit more on the details that the IRS has put forward in terms of being able to reduce your rental income profit. All that and more on the program. This is Joel Garris of Nelson Financial Planning. Dollars and Cents on News Radio WFLA Orlando. Welcome back, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA. This segment of the program, it's tax time, or it is rapidly approaching. You've certainly by now gotten a number of your tax documents, which means that you also, if you're using a tax professional, should have also gotten an organizer of some sort. And now you're trying to organize and put all of that stuff together. And one of the things that comes out is, what's the difference between a credit versus a deduction? We hear all these terms tossed around, and I think one certainly is much more valuable than the other. So when we talk about deductions, we're generally talking about things like your mortgage interest or your medical expenses or your student loan interest or your IRA contribution or your health savings account. Those are all deductions versus credits, which are things like your child tax credit, your American Opportunity credit, your earned income credit, things like that. So there's definitely two distinct categories. And once you understand what each one does, then the answer is pretty clear which one is more powerful. So a deduction winds up reducing your income. When you put your income on your tax return, then you have a bunch of deductions, and those ultimately reduce your income. And then from your taxable income, after all of your deductions have been done, then the tax return then calculates your tax bill. A credit, on the other hand, is a credit for that tax bill. So a credit gives you a dollar for dollar reduction in the amount that you owe. So pretty obvious which one's better, right? I mean, you want the credit or you want a deduction. A $2,000 credit reduces your tax bill by $2,000. A $2,000 deduction, let's say it's student loan interest, and so student loan interest, $2,000 write-off is just that. It's a deduction from income. If you're in the 22% tax bracket, saves you money, saves you $440, but that's not the same thing as $2,000. So, for example, if you have the American Opportunity Credit where you're going to college or one of your dependents is going to college, then that can produce a tax credit of $2,000. That's a $2,000 reduction in your tax bill, again, versus a deduction, which is only a $440 reduction in your tax bill. So know the difference between credits versus deductions. In addition to that, many deductions are an either-or type of proposition, meaning you can't get both, whereby with credits, if you're eligible for them, you can get them. Deductions, it's an either-or approach when it comes to itemized deductions versus standard deductions. So your itemized deductions are all those things that we typically think about: mortgage interest, charitable contributions, medical expenses, real estate taxes. All of those are deductions, but you have to choose between taking those versus the standard deduction. The standard deduction today, much higher number than it has been thanks to the tax changes that occurred in 2017. So standard deduction north of $24,000 for a married couple. For that, you have to compare versus your itemized deductions, and you must choose. You don't get both when it comes to deductions. So understand, certainly deductions are good, and you want to have those on your return, but make sure you're paying more attention to where the credits can come in, because tax credits are much more powerful and have a much greater impact on your tax return. So, some important distinctions: deductions versus credits. Another important distinction is this notion of qualified business income. Again, relatively new concept, been around since the tax changes of 2017. And one of those places where this qualified business income deduction can come into play is, let's say you are self-employed, you have your own business, and it shows a profit. Again, this is a deduction from income. If you've got a loss, then you're not going to get it, but this is a deduction off of profit. So let's say you're self-employed and you've got a business, and then that consequently means that you're able to write up to 20% of that income off as a deduction. Now, there's a variety of limitations, particularly based upon the types of services or types of jobs that you're doing. But one of those places where the qualified business income deduction comes into play is as it relates to rental property. Rental property, after all, can certainly be considered a business, and so consequently, this deduction would also apply. However, because these are relatively new changes, the IRS just recently issued out some final rules that you must follow in order to get that deduction as it relates to your rental property. So let's say your rental property has a positive cash flow, a positive number on your tax return after depreciation, expenses, all that, of $5,000. The qualified business income deduction would allow you to write 20% of that off, or $1,000. But here's the thing. You've got to satisfy the safe harbor, which now means that you've got to maintain a number of separate books and records, including things like time logs, description of hours, and the dates of all services performed and who performed them. Because in order to qualify for the deduction, you must show that you spend 250 hours or more, effectively making it a business that you worked in. You must show that you've got at least 250 hours in with that rental in order to be able to get the qualified business income deduction. These rules are all very new. There's a much greater threshold now that you have to observe in terms of the books and records and keeping track of logs and who did what and how much time you spent on it in order to justify that. So just know that if you got rental property and you took advantage of that qualified business income deduction last year, you've got a much higher threshold in terms of the books and records that you must maintain along the way. Things like advertising, things like collecting rent, things like the daily operations, the lawn, the maintenance, the cleaning, all of that. You have to keep track of that, and it has to be at least 250 hours. It doesn't have to be you doing it. You can pay for somebody to do it, but you have to accumulate all of that and make sure that it meets that threshold. So some very different rules now in terms of what you must have as your records in order to justify that qualified business income deduction as it relates to rental property. So some new stuff on that that we wanted to share with you on the program today. We're going to wrap it up and get on out of here. Thank you very much for listening to the program. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio, WFLA Orlando.